Hello, welcome to the Baker Boyer Monthly Market Update. I'm Ted Cohan, one of the senior portfolio managers here at Baker Boyer Bank. We do the monthly series here, and the last month, John and Tyson did a really expanded monthly market update. They did kind of a mini economic update, giving a lot more detail on the economy, the markets, what's going on. Since that time, there hasn't been any really big developments to make sure to go over. So I thought what we'd do for this monthly market update, I'm going to kind of just do a recap of where we are so far year to date, looking at the U.S. markets, international markets, and the bond markets, and a little bit of economic news. So I'll start on the U.S. market. What we've seen so far this year is the beginning of the year, January, February, March, there was certainly volatility in the market, but we were kind of moving on a little bit of an upward trend. Then in April, President Trump came out with his new tariffs. The tariffs pretty much across the board to all countries. The market immediately went on a big sell-off, down over 10% within a few weeks period. After that time, there's kind of been a little bit of waffling back and forth on tariffs, tariffs on, tariffs off, different percentages. So we have had a nice little rally back in the market, gaining back most of what we lost in April. So where we are right now, as of June 3rd, when we look at kind of the main indexes that people follow, the S&P 500 is one of the main ones that people look at. That follows 500 of kind of the larger cap names in the U.S. market. That's up about 1.5% so far year to date. The NASDAQ, which is more kind of technology driven, a little bit more growth, is up about 0.5%. The Dow, which is one that we don't really follow, I don't think it's a great index to follow, but it's still a name out there a lot. If you watch TV, you hear about the Dow, but it's only 30 names. That is flat for the year. And then the benchmark that we really like to follow for the U.S. is the Russell 3000. As the name says, that has 3,000 different names in it. It has a good variety of small cap, mid cap, large cap stocks, also growth and value. That's also up about 0.5% for the year. So again, just a slight increase so far year to date. A lot of volatility. We're expecting a lot of volatility continuing kind of going forward as we continue to find out more about tariffs, budget bills. But so far, that's where we are on the U.S. side. The brighter spot really has been two different areas. What we consider kind of a little bit of an alternative bucket. We have a fund that invests in global real estate, basic materials, infrastructure, and a little bit of precious metals. That's up close to 8% so far this year. And then really the best performing so far has been the international markets. The two main indexes there are the MSCI All Country World Index minus the U.S., so that's kind of more developed countries around the world except for the U.S. That's up close to 15% so far year to date. And then the MSCI Emerging Markets is up 7.5%. So again, we've seen a nice little change in the international market, which really has been significantly underperforming for the last 10 to 12 years. It seems it's kind of doing a little bit better this year. We think that trend might continue also just when you look at kind of historical price to earnings ratios on the international versus the U.S. On the bond side, what we've seen is that the 10-year Treasury, which is really kind of the main interest rate that drives really interest rates across the board as far as bonds, as far as mortgages, loans. That started the year at about 4.58%. It did dip down to under 4% when we had the sell-off in April in the market. It has come back up to 4.46. So the interest rate is down a little bit. What that means is that's given a little bit of price appreciation to bonds. So bonds have been paying a pretty good yield. Plus you got a little appreciation. So bonds are up about 2.2% when you look at the U.S. aggregate bond index so far year to date. Economy-wise, I'll just cover a couple different areas. I just want to talk about GDP and then also the Federal Reserve. GDP in the first quarter had its first negative GDP for a while. It was down 0.2%. Economists' estimates for the second quarter are all saying that we expect positive GDP range somewhere between 3% and 4%. So that means we won't have the two negative quarters of GDP, which is what you need for a recession. So it looks like we're going to avoid that at least for the first part of the year. And then the Federal Reserve has held rates steady for the whole year. Every time they meet, which is every 6 weeks, the last couple times they've said they're going to continue to hold it steady until they really get a clear picture on what the economic policies are going to be. So what they really want to see is tariffs to kind of be settled, to figure out where are tariffs going to settle in, what rate they're going to settle in. Also, when you look at budget bills, we had a large budget bill that has passed the House, but not the Senate. I think they'd like to see that and tariffs settle down before they decide kind of what they can do with interest rates. So we do expect rates to remain steady for the foreseeable future going forward. And with that, I'll wrap up this monthly market update. As always, if you have any questions, please reach out to your advisor or portfolio manager. And if not, we'll be back next month with our next update. Thank you.